Yeah, last week we started capital budgeting, and we were able to dissected introduction to capital investments. We discussed the procedures involved in capital budgeting decision. Thereafter, we moved to discussing the characteristics of capital budgeting. Then we now started with, we move on to discussing methods of project evaluation, under which we talked about discounted cash flow method, then we talk about non-discounted cash flow method. Then we begin to discuss the techniques under each of them. Specifically, we discuss net present value method. We discussed internal rate of return, modified internal rate of return. We also talked about project duration. I think that's where we stopped last time. So today, we are going to be uh, discussing the techniques under the non-discounted cash flow method. We are going to talk about payback period as well as accounting rate of return. And I also mentioned that the discounted cash flow method is under the discounted payback period is under the discounted cash flow method, which of course we're also going to do it today because I mentioned last week that we need to talk about payback period first before we begin to talk about discounted payback period. Okay, so once we are done with those three techniques, then we move to discussing relevant cash flow, how to identify relevant cash flow in a question. Then if we still have time, we are going to talk about impact of inflation and taxation. So my objective today is to complete all the underlying discussions around capital budgeting decision so that subsequently we are just going to be doing calculation all through. All right. So let the class begin. So we are starting with the payback period. All right. We are starting with payback period. So what do you understand by payback period? We said payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow in capital investments. All right, you can open to the material at your end. Okay, so I said payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow in capital investments. The payback period is a measure of liquidity. That is, how quick or how soon can a company recover the amount invested in a project. Say, for example, you want to invest 1 million naira in a project. Then you want to know how long will it take you for you to be able to recover your money on the project, or how long will it take the project to pay back your invested capital. That is basically what payback period is all about. And that's why we said that it's a measure of liquidity. However, when calculating payback period, you need cash flow, okay? You are supposed to use cash flow to recover your initial investment, unlike the accounting rate of return, whereby you use accounting profit, okay? So that's basically what payback period is all about. Again, at this level, examiner cannot be asking you what is advantages and disadvantages of a payback period. But again, it's good for you to know, all right? Ensure you go through it, have the understanding. Now, how do you compute payback period? How do you calculate payback period? There are two ways in which you can calculate payback period, depending on the cash flows, the cash inflows given to you, depending on the nature of the cash flow given to you. If you have a regular cash inflow or constant cash inflow, then payback period is calculated as the ratio of cash outflow to constant cash inflow. That is, whenever you want to calculate payback period where you are given constant cash inflow, all you need to do is to divide the cash outflow, the initial investment, you divide it with the constant cash inflow. Say, for example, you are given a cash flow as follows. Say maybe you have initial outlay. You are given initial outlay to be 100,000 naira, right? So you are also told that this project will generate annual cash inflows. All right, the project will generate annual cash inflows of say 30,000 naira. All right, for simplicity, let's say 40,000 naira, and this project will last for the next 3 years. So the useful life of the project is 3 years. So these are the information given to you. You now have to calculate payback period. All right. So all you need to do is to divide the cash outflow with the constant cash inflow, because this 40,000 naira will remain constant for the next 3 years. So in that case, instead of me to use tabular method to calculate my payback period, then I will just use this formula and I will get the answer I'm looking for. So in this case now, for me to get my payback period, I will just say 100,000 naira, right, divided by 40,000 naira. So your payback period will be something around 2.5, I think. All right. So that would be 2.5 years. You have to express your number in years. So that's how you are going to calculate your payback period. Okay. Yes, Tony, please mute. Tony, Eden. Tony, Eden, then TY, Tayo, mute. Your speaker is on. Okay. So that's how to calculate payback period. All right. Now, what if you are given non-constant or irregular cash inflow? What if the cash inflow for each year are different? Okay, how do you then calculate the payback period? Of course, where you have irregular cash inflow, you are not expected to use this formula. All right, you can't use this formula to calculate your payback period. So you have to use this tabular method. Use this table with this format. All right, let's say, for example, you are given cash flow in year 1 to be 40,000 naira, cash flow in year 2 to be 70,000 naira, cash flow in year 3 to be 30,000 naira. The initial outlay given in the question is 100,000 naira. All right. So you are now asked to calculate payback period. So all you need to do is to create 4 different columns. The first column will be for year. The second column will be for description of items. The third column will be for cash flow, and the fourth one will be for cumulative balance. All right. So starting from year 0, from your calculator, you are going to type 100,000 naira. So from that on, because you want to recover the 100,000 naira that you have invested, therefore you put 100,000 naira in your calculator. So you don't say 100,000 minus 40,000. In the first year, you have recovered 40,000. That means the balance to recover at the end of year 1 is 60,000. Then you move to the next cash inflow. You can see that the outstanding balance after recovery of year 1 is 60,000. When you get to a point where the outstanding balance is less than the next cash inflow, you are going to put a dash and calculate your payback period. In this case, because 60,000 naira is less than 70,000, that's why we put a dash here. Then we calculate the payback period. So you need to ask yourself, how many years have you recovered? You have only recovered for year 1. All right. So you then say 1 plus the outstanding balance of 60,000 divided by the next cash inflow of 70,000. Put it in your calculator. You get 1.86 years. That means this project will pay back within 2 years. All right. The project will pay back within 2 years. So that's how to calculate payback period using tabular method. What if the cash flow given to you in the question in the second year is 40,000, for example? What if it is 40,000? It's still the same thing. What are you going to do? All right. In the first year you have recovered 40,000. You are left with outstanding balance of 70,000. All right. So you are left with outstanding balance of 70,000. So I would then say 40,000. What am I saying? You are left with after outstanding balance of 60,000 at the end of year one. So you then move to the next one, the next cash inflow. And we are saying that, let's say, for example, this one is 40,000, right? So I would then say 60,000 minus 40,000. I have balance of 20,000 to recover at the end of year two. Okay? I will then move to the next one. The next cash inflow is 30,000. But the outstanding balance at the end of year two is less than the net cash inflow. Therefore, I will put a dash. I will calculate my payback period. In this case, I need to ask, how many years have I recovered? I've recovered for year one. I've also recovered for year two. Therefore, my payback period in this case will then be equal to 2 plus the outstanding balance of 20,000 naira divided by the next cash inflow of 30,000. So this will give me something like 2.6 something to third, 2.67, for example, years to third to be 66, so let's say 67. So that's 2.67 years. So which means that this project will pay back within 3 years, So this is how to calculate payback period where you have non-constant or irregular cash inflow. Okay, so that's how to calculate payback period. At this level, I doubt if examiner can. It's been a while. The last time ICAN tested the payback period, I think it was, I can't remember. It's been a while, I think around 2016 or 2015 or thereabouts, But in any case, you never can tell. Examiner may want to give it to you as a bonus. All right. So, so that's that. Then, what's the decision rule for payback period? What is the decision rule? All right. When you have calculated your payback period, it's expected that you are going to advise on what the company should do. Therefore, how do you advise? Number one, for independent projects, okay, accept if the payback period is lower or equal to management predetermined payback period, all right? Accept if payback period is lower or equal to management predetermined payback period. Okay. For mutually exclusive projects, accept any project with a shorter payback period, provided it is lower or equal to management predetermined payback period. Okay. For mutually exclusive projects, accept any project with a shorter payback period, provided it is equal to or lower than the management targeted payback period. What do I mean by this? Let's say, for example, we are told that project A and B are mutually exclusive, and you have calculated payback period for project A to be 2 years, project B to be 1.8 years. Then the management targeted payback period is given as 2.2 years. So examiner is this is what we have calculated. All right. So at this point, because they are mutually exclusive, you cannot accept project A and B together. You have to select one of the two. So project B has a shorter payback period, even though both project A and B are financially viable, because the two of them are shorter than the management predetermined payback period. But because of the fact that you cannot accept project A and B together, therefore project B with a shorter payback period of 1.8 years will be accepted. And then, of course, which means that project A will not be undertaken. All right. So that is the decision rule as far as mutually exclusive project is concerned. Pay attention to what I want to say. Now, examiner can ask you to calculate payback period, and you then have to advise on the acceptability of the project. Whenever you want to make a decision under payback period, whether the company should accept the project or not, you are expected to compare, you are expected to benchmark your calculated payback period with the management predetermined payback period. So if the management predetermined payback period is not given to you, there will be no basis for the acceptability of the project. So in this circumstance, what are you supposed to say? Simply put, if what I'm trying to say is that in case if examiner does not give you the management predetermined payback period in the question, because you need to benchmark it, you need to benchmark your calculated payback period with the management targeted payback period. So what I'm now saying is that if management intended or predetermined payback period is not given to you, there will be no basis for the acceptability of the project. So in this case, what you are supposed to say is that, okay, the calculated payback period is, for example, let's say for this project A, for example, which is 2 years. So you then say the calculated payback period is 2 years, or this project will pay back the initial investment within 2 years. However, there will be no basis for the acceptability of the project since management predetermined payback period is not given. That's all you need to say. But if management predetermined payback period is given to you, then you don't need to say that. Just say the project will pay back within 2 years relative to management predetermined payback period of 2.2 years. So this means that this project is financially viable and should be undertaken. That's all. That's all. So that's the decision rule for payback period. Let's move on to the next one. All right. So that's all about payback period. It's as simple and straightforward as that. All right. So let's go to, let's briefly touch, let's touch discounted payback period. So I wanted to tell you this last time, in our last class, but I said it's better. Let's have payback period, the normal payback period first, before we talk about discounted payback period. So there's nothing big about discounted payback period. It's the same thing as the normal payback period. All right. But the only thing is just that instead of you to use normal cash flow to recover the initial investment, you are using present value to recover the initial investment. That is, when calculating discounted payback period, you must first of all discount the cash inflow generated by the project. You would discount it to the present value equivalent. So it is that your present value you then use to recover the initial investment. For example, in this our table, in this our hypothetical table, let's say, of course, these are the cash flows given to you. The cash flow generated by the project in year one is 40,000, year two is 70,000, year three is 70,000. So if you want to calculate payback, and then the initial outlay is 100,000. So if you want to calculate discounted payback period, so instead of you to use cash inflow to recover the initial investment like you normally do under the payback period, so you need to first of all discount all this cash flow. You discount it using the company cost of capital. You discount it to the present value equivalent. Then, of course, you are going to create additional column here. You call it present value. All right. We call it before that. We create a column for discount factor. Okay. Let me clean. What's wrong with you? Clean. Okay. So you create a column first for discount factor. Why are you stressing me? Okay, for example, you create a column, call it discount factor. All right. Then you create another column for present value. Create another column for present value. So then you create the last column for your cumulative. You create the last column for your cumulative. So you know, of course, you get all your discount factor here, whatever it is, get your discount factor, then you multiply with the cash flow to get the present value. All right, you get the present value. So it is this, you then say 100,000 naira for example, minus the present value of year one. Whatever the balance you have at the end of year one, then you carry forward, continue to recover it. So what I'm trying to say in essence is that when you are calculating discounted payback period, instead of using normal cash inflow to recover the initial investment, you are supposed to use present value to recover the initial outlay. So that's all you need to do under the discounted payback period. Okay, so let's move to accounting rate of return. Let's talk about accounting rate of return. The accounting rate of return is also known as return on investment or return on capital investment. It's a technique that relies heavily on accounting information as shown in the financial statements of a company. I repeat, accounting rate of return is also known as return on investment or return on uh, capital employed. It's a technique that relies heavily on the accounting information as shown in the statement of on the financial statement of a company. Okay, the accounting rate of return uh, is a measure of profitability, unlike payback period that measures liquidity. All right. The accounting rate of return is a measure of profitability, unlike uh, payback period, which measures liquidity. So when you are calculating accounting rate of return, you need accounting information, you need accounting profit or loss. You don't make use of cash flow. So this simply means that if you are given a cash flow, you must convert it to accounting profit or loss before you begin to calculate uh, accounting rate of return. I repeat, when you are calculating accounting rate of return, you don't make use of cash flow. All right, you have to be very careful. Once you see in a question that you are asked to calculate accounting rate of return, you must check from the question whether you are given accounting profit or cash flow. Because in most cases, the examiner will give you cash flow, and you don't use cash flow to calculate accounting rate of return. It has to be accounting profit or loss. All right. But if cash flow is given to you, what are you supposed to do? Simple. Just convert the cash flow to accounting profit by deducting annual depreciation from the cash flow. When you deduct annual depreciation from cash flow, you are going to get accounting profit. Okay. So how do you then calculate accounting rate of return? To get accounting rate of return, simply calculate. Of course, before you begin to calculate accounting rate of return, you must first of all carry out some steps. You do some workings. The first working you are going to do is to calculate annual depreciation. All right, because like I said, in most cases, examiner will surely give you cash flow. And for you, you need to convert that cash flow to accounting profit. So with this, you need to first of all calculate annual depreciation. Once you have calculated annual depreciation, then you now need to calculate average annual profit. When you calculate average annual profit, you proceed to calculating average investment. After average investment, then you calculate accounting rate of return. Okay, so that's that. That's what you need to do. So, like I said, to calculate the accounting rate of return, is simply average annual profits, AAP, average annual profits over average investments. Okay, over average investments. Everything multiplied by 100%. You have to multiply your answer with 100% because it's in percentage. Your rate of return must be in percentage. All right. So now, like I said, you can't just go ahead and be calculating ARR. You need to first of all do your working because average annual profit will not be given to you. Average investment will also not be given to you. So the next thing you are going to do is to calculate average annual profit. Okay. So to get the average annual profit, if accounting profit is given to you in the question, that was very easy. Just add up the profit, then you divide it by useful life. It will give you average annual profit. But like I said, in most cases, average and profit will not be given to you. Examiner will only give you cash flow. So if that is the case, cash flow, the cash inflow minus annual depreciation divided by the useful life. Okay, it has to be cash flow of each year minus annual depreciation of each year. So you add everything together, that will give you profit. Then you divide it by the useful life. Okay, so like I said, the difference between cash flow, and then depreciation will give you profits. So you add up all the profits. So that will give you total profits. Profit of year one, profit of year two, profit of year. It is possible the cash flow may be less than the depreciation. That means you are going to have a loss. So you are going to add up both profit or loss, add everything together, then you divide it by the useful life. Okay, so this will give you the average annual profit. After you have determined the average annual profit, then you need to calculate average investment. So the average investment is the cost of the project. Okay, is the cost of the project plus the scrap value. Okay, the initial outlay or the cost of project cost plus scrap value divided by 2. If you are not given scrap value in the question, you put 0. 0 is also a figure. Put it there. So that will give you average investment. All right. Again, to get your depreciation. So you then say depreciation is the cost of the project minus scrap value, then divided by the useful life. Divided by the useful life of the project. So that will give you annual depreciation. So your first working will be the annual depreciation, followed by the average annual profit, then average investment. Once you are done with all those working, then you can proceed to calculating the accounting rate of return. It is very straightforward, very straightforward. And then, yes. So what are the decision rules? What are the decision rules under accounting rate of return? For independent projects, okay? For independent projects, you accept if your calculated ARR is greater or equal to management targeted ARR, okay? You benchmark your calculated ARR with the management predetermined or targeted ARR, provided your calculated ARR is higher than or equal to the management targeted ARR, then that means the project is financially viable. So that is for independent projects. For mutually exclusive projects, you accept any project with a higher ARR, provided it is greater than equal to management's intended ARR. Okay, so that's the decision rule for mutually exclusive projects. All right. Okay. So that's that. Again, accounting rate of return. You can see that the decision rule under accounting rate of return is also based on management predetermined ARR. So what that simply means is that for the non-discounted cash flow methods, all right, for the non-discounted cash flow techniques, all right. So your calculated figures should be compared with the management targeted figure, all right. So when you are making the decision, so what that simply means is that if you are not given management targeted figures, there will be no basis for the acceptability of the project. That's what you need to do, or that's what you need to say. All right. Again, please go ahead, read about the advantages and disadvantages of accounting rate of return. It's as simple as that. It's as simple as that. For a very long time, ICAN has not tested the accounting rate of return. It's not common. It's expected because at this level, you need something more technical. All right. But again, you never can tell. Examiner may want to dash you. I want to dash you the question. So as a bonus, then no matter how cheap is a question, if you don't know, you don't know. All right. So that's that. So we are done with the explanation of all relevant techniques. The next thing we want to do now is to explain or to discuss relevant cash flow. All right. Let's talk about relevant cash flow. Let me see if I have it here. If not, I will switch to the working notes. Relevant cash flow. Yes, I have it here. All right. You know, for some of you that are coming from skills level, you did performance management. And then during that time, you learn about relevant cost for decision making. So relevant cash flow is similar to what you did under relevant cost for decision making. So what do you mean by relevant cash flow. Relevant cash flows are cash flows of receipt and payment. Okay, they are cash flows of receipt and payments that are directly attributable to the project under consideration. I repeat, relevant cash flow are cash flows of receipt and payments that are directly attributable to the project under consideration. All right. So in the determination of financial viability of a project, the following line items must be critically examined, okay? Whenever you want to appraise a project or you want to determine the financial viability of a project, you must consider the following line item, you must review and analyze critically the following line item. The first item here is variable cost, okay? The second one is fixed cost. The third one is depreciation, amortization, or provision, okay? Or provision. Then 4 is interest. 5 is incremental. Okay, we can say incremental slash direct slash specific slash attributable. Attributable fixed costs. All right. Then we have working capital, we have opportunity costs, then we have sunk costs. Let's talk about each of them because on the day of your exam, you are going to see some of them in a question. How do you treat it? How do you treat all these cash flows or these line items? How do you treat them when you see it in a question? So let's talk about it. The first item is variable cost. Of course, variable costs are costs that vary according to activity level. Okay, the more production volume that a company produce, the more the units the company produce, the more variable costs that the company will incur. All right, so there are costs that vary according to activity level. Examples of variable costs include direct material, direct labor, direct expenses, or variable overhead. I said examples of variable costs include direct material, okay, direct labor, direct expenses, okay, then variable overhead. These are examples of variable cost. So when you see them in a question, when you see direct material, direct labor, direct expenses, or variable overhead in a question, it means they are relevant. Okay, variable costs are relevant cash flow and should be considered. You must include it in your calculation. When you see variable costs in a question, you have to include it. Okay, you have to consider it in your calculation. The next one is fixed cost. Fixed costs are costs that have no sympathy for activity level, which means that irrespective of the production volume, irrespective of the number of units produced, fixed costs will not change. Provided fixed costs will not change, then it is irrelevant. All right. Provided fixed costs will not change, it is not relevant. All right. So, but again, there are 3 different ways examiner can test you on fixed cost. You have to be very careful. The fact that I said fixed cost is not relevant because it's not, since it's not changing, all right, does not mean at times examiner may, there are 3 different ways examiner can test you as far as fixed cost is concerned. The first one is that if you are given a fixed cost with no additional information, no further information is given, you are just given a fixed cost. Say, for example, the company intends to incur, or the company incur fixed cost of 100,000 naira. No further information. In that case, that particular fixed cost is irrelevant. It's not relevant. Number 2, if you are given a fixed cost, if you are told that fixed cost, including depreciation, If you are given fixed costs that include depreciation, that fixed cost is also not relevant, but examiner wants you to do something, all right? So that means you need to go and calculate annual depreciation. Then you now less it from the fixed cost. Whatever you have thereafter is relevant. Say, for example, you are given a fixed cost of 100,000 naira. You are now told that including depreciation, okay, including fixed costs, including depreciation. So in this case, this 100,000 I said is irrelevant, but I need to go and calculate annual depreciation. Let's say, for example, you are told that the cost of the equipment is 50,000 naira. The cost of the equipment is 50,000 naira with a useful life of 5 years. Therefore, I will then go and calculate annual depreciation. 50,000 naira divided by 5 years will give us 10,000 naira. So that means annual depreciation is 10,000 naira. So to now get my relevant fixed cost, I will then say, of course, fixed cost will then be equal to 100,000 naira minus 10,000 naira. So that means the relevant fixed cost in this case will be 90,000. So I repeat, whenever you are given fixed costs that include depreciation, that fixed cost is not relevant. However, examiner wants you to do something. What are you supposed to do? You calculate annual depreciation based on the information given to you. Then you now less the depreciation from the fixed cost given. The difference is a relevant fixed cost. You consider it. Now, the third way examiner can test you on fixed cost, examiner can tell you that fixed cost excluding depreciation. When you are given a fixed cost that excludes depreciation, that fixed cost is relevant. You must consider it. You must consider it. So let me repeat the three of them. I said the first one, if you are given a fixed cost, no further information, just fixed cost, 100,000 naira, for example, that fixed cost is not relevant. Then the second one, examiner can give you a fixed cost, including depreciation. And I said that fixed cost is also not relevant, but you need to calculate annual depreciation and then less from the fixed cost. The difference is relevant. You must consider it. The third one is when you are given a fixed cost that exclude depreciation. I said that fixed cost is relevant. You must consider it. So that is how to treat fixed cost in a question when you see it. Then the next area we are going to discuss, all right, is before any other one is this line item here. So if you are given incremental, direct, specific, or attributable fixed costs, they are all relevant. When you are given incremental fixed cost in a question, you must include it, you must consider it. If you are given a direct fixed cost, it is relevant. If you are given specific fixed cost, it is relevant. If you're also given attributable fixed costs, they are all, all of them are relevant. You must consider it. Okay. Now, let's talk about depreciation. All right. Let's talk about depreciation. What do you mean by depreciation? Depreciation, of course, depreciation, amortization, or provision are notional costs. They are notional costs. They are not cash flow. So because depreciation, amortization, provision are not cash flow, then they are not relevant because they do not involve movement of cash. They don't involve movement of cash, so we have to ignore it. In that case, when you see depreciation, amortization, or provision in a question, please ignore. They are not cash flow because when you want to determine financial viability of a project, you need cash flow. Depreciation is not a cash flow, so that's why you have to ignore it. Now, the next line item would then be interest. Let's talk about interest. All right. Of course, interest is the compensation required by the providers of debt capital. When you borrow loan, okay, the charges, the amounts, the charges you are going to pay on the loan that you borrow is the interest. All right. Now, the issue now is that the absolute amount of interest is irrelevant. So the naira amount that will be that, let's say, for example, if you are given in a question, you are given interest. You are given interest of 10,000 naira like this. So it means that when you see absolute amount of interest in a question, it is not relevant. It's not relevant because the cost of capital that you are going to use to discount the future cash flows already included interest. So if you now include interest in your calculation, that means you are double dipping. That means you are treating interest twice. You are treating interest twice. So you don't include the naira amount of interest in a question when you are given. You have to ignore it completely. Don't include interest in your calculation. You ignore it. All right. So that is the treatment of interest, because once you do that, that means you are treating interest twice. You are double dipping, and you must avoid that. You have to avoid that. Yes, Charity, Informer, talk to me.
Good evening, sir.
Good evening.
So my question is, you said when we are giving the naira amount of interest, we should
Interest.
not include it. What
Yes.
if the question is, what if the question is like the 10% interest on maybe the 10% interest is they now put a naira amount, but they wrote out the 10% too. Do we
Yes.
ignore it?
So whether the interest is given to you in absolute amount, like in this case now where you have 10,000 naira, or it is given to you in a percentage, don't include it in capital budgeting. You don't need interest for anything. All right. So whether it is given to you in a
Okay.
percentage or it's given to you in absolute number, all right, you don't include interest. Why is it that you don't include interest? The reason being that, when we calculated cost of capital, we use interest, isn't it? When we calculated WACC, we calculated cost of equity, cost of preference share, and the cost of debt. When we were calculating that cost of debt, we included interest, isn't it, to get our WACC. So because the cost of capital you are going to use to discount the cash flow already included interest. So if you now consider element of interest, that means you are treating interest twice. And that's why in a question, once you are given interest, you have to ignore it because it is not relevant. You don't include interest at all in your calculation. You have to ignore it. All right? Is it clear, Former?
Yes, sir. Thank you.
Okay. So, who's consulting? Yes. Tell me what's the name? You say I'm too fast. Okay. Sorry about that. I will adjust. I will adjust. It's my nature, but I will adjust. I will try and talk to you slow, slow, like one of the comedians will say, "You are too slow, slow." All right. I will take it slowly. Okay. Yes. So that's as per interest. Then the next item, oh, okay. Let me do it this way. Okay, so the next area we are going to discuss, okay, we have talked about variable costs, fixed costs, depreciation, interest, and then incremental, direct, specific, attributable fixed cost. Let's talk about sunk cost. All right, let's talk about sunk cost. Sunk costs are past costs. They are costs that have already been incurred. Okay, they are kind of historical costs. So relevant cash flows are future cash flows of receipt and payment. So any costs that have been incurred in the past, any costs that have been incurred in the past are not relevant. So you have to ignore it. So when you are given a past cost, when you are given a sunk cost or historical cost, they are not relevant. You have to ignore it. Example, in the question, there is no how. If you have any question on capital budgeting, certainly examiner will give you some cost. You are going to be given some cost. Usually, common examples of some cost include development costs, market survey or market research costs. You can be given research and development costs. Examiner can give you feasibility study fee or cost. So once you have any of those costs in a question, you should know that they are not relevant, irrespective of when the payment will be made, provided the activity has been completed. They are not relevant. All right, because examiner can tell you that in the determination of the scenario, in determining the selling price for this project, the company has carried out market survey. They have carried out market survey of 10,000 naira. This amount is due for payment in the next 1 year. So provided the activity has been completed, certainly that cost is not relevant. In most cases, all these examples that I mentioned to you, they are not relevant. They are not a relevant cash flow because relevant cash flows must relate to the future. All right. So that is as per that. Now, we have two more to go under this. Let's talk about opportunity cost. Let's talk about opportunity cost. Opportunity cost is a benefit forgone as a result of taking a particular course of action. All right. When you choose a particular line of or a particular course of action over the other, that means you are going to forgo the benefit that would have accrued to you from that course of action. Say, for example, uh, as a lecturer, let's say I have, for example, let's say I have a car. All right, let's say I have a car. I can use that car for Uber service to earn revenue, right? I can use that car for Uber service to earn a revenue. So if I choose to drive myself to the lecture center, that means I will not be able to earn revenue from my Uber service. Therefore, if I want to determine the cost of my lecturing, I have to include the benefit that I've lost through Uber service. I have to include it as part of my cost of lecturing. Okay. So let's say another example is that let's say a company has a storage space. All right. A company has a storage space and then the company wants to execute a project whereby they are going to put that project in the storage space. And there's a neighboring business that wants to rent the space. But because of the fact that the company will need the storage space for the project, they will not be able to earn the revenue from the customer. That means they are going to forgo that revenue that would have accrued to the company through the customer. So in that case, that is what we call, that's another typical example of opportunity cost. The benefits that you forgone as a result of taking a particular course of action is what is known as opportunity cost. So when you see opportunity cost in a question, you have to consider it. It is relevant. It is relevant. You have to consider it. And then the last area we are going to discuss is working capital. Working capital. What do you mean by working capital? Working capital represents the difference between current assets and then current liability. I repeat, working capital represents the difference between current assets and current liability. Okay. In the determination of financial viability of a project, working capital should be considered. Working capital should be included. However, how do you treat working capital? There are two different ways you can treat working capital in a question, depending on the nature of the working capital given to you. Let me explain the two. Examiner can give you a one-off working capital. One-off working capital. How do you treat a one-off working capital? This should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. Working capital, a one-off working capital should be treated as a cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. That is how you are going to treat a one-off working capital. What do you mean by a one-off working capital. Let's say, for example, you are given a working capital of, you are told that a company will incur working capital of 5,000 naira in year 2, for example, in year 2. And let's say the useful life of this project is 3 years. So you can see this 5,000 naira will occur only in year 2. So that's a one-off. Therefore, how do you then treat the working capital? In this case, when I'm calculating my NPV, I will create a column for year 0, year 1, year 2, year 3. The rule says that working capital should be treated as cash outflow in the year before the year of occurrence. Our example, working capital of 5,000 naira occurs at the end of year 2. So instead of me to put it under year 2, I will not, because the rule says that it should be treated as cash outflow in the year before the year of occurrence. Year before year 2 is year 1. So I will then come here 5,000. So the rule says should be treated as cash outflow. I will put it in brackets. Then at the end of the useful life is 3 years. I will recover the entire working capital. So here will be 5,000. In this case, I've recovered the one-off working capital. I've recovered it's now equal to 0. 5,000 minus 5,000 is equal to 0, even though the present value will be different, because by the time you discount the 5,000 of year 1, this 5,000, when you discount it with the appropriate discount factor, and you discount the one of year 3, it's not going to be the same again because of time value of money. All right, because of time value of money. All right, so that is as per that. This is how to treat a one-off working capital. The second one is incremental working capital. If you are given incremental working capital, how do you treat it? Okay, so incremental working capital should be treated the same way as a one-off working capital, except that only the increment should be considered. Okay, I said incremental. Let me see if I can put it down here. Incremental working capital should be treated, as a one-off working capital, except that only the increments should be considered. What do I mean by that? We said that working capital should be treated as a cash outflow in the year before the year of occurrence. So that's what I'm trying to say here, that the incremental working capital should be treated the same way as a one-off working capital. All right, but only the increments should be considered. So let's say, for example, you are given an increment, you are given a working capital like this, okay? In year 1, year 2, year 3, for simplicity. Let's say you are given working capital in year 1 to be 100, working capital in year 2 to be 120, working capital in year 3 to be 150. You will notice that the working capital has increased from 100 naira to 150 naira. So that means Yusuf, mute.
So sorry, sir. So sorry.
So you will notice that the working capital has increased from 100 naira to 150 naira within the 3 years. All right. So you cannot use 100, 120, 150 in your calculation. First thing first, you must determine the increment. So in this case, from these hypothetical figures that you have here, what are you supposed to do? Simple. Let me push it down so that it will be clearer. What are you supposed to? First thing first, you must determine the increment. So I would then say incremental. Let me push it to the back. So I will say incremental working capital. I will do for year 0, year 1, year 2, year 3, then total. Okay. So the one of year 1 is 100 naira. The one of year 2, you can see that the working capital has increased from 100 naira to 120 naira. So the difference is 20. So the increment is 20. From 120, it has increased to 150, the difference of 30. So I'll put 30 here. So when I add everything together, I must have the same thing as 150. So the rule says that working capital should be treated as cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. Therefore, if I like, I can then say relevant year. The one that occurs at the end of year 1, I will treat it as cash outflow. Okay, I will treat it as cash outflow in year 0. Okay, I will treat it as cash outflow in year 0. The one that occurs at the end of year 2, which is increment of 20, I will treat it as cash outflow in year 1. The one that occurs at the end of year 3, which is 30, I'll treat it as cash outflow at the end of year 2. Then at the end of the useful life of the project, which is 3 years' time, I will recover the entire working capital of 150. So this one will be, of course, since I recover it, so to be positive. By the time you add everything together, minus plus 150, 100 plus 20 plus 30, that's 150 negative, then 150 positive, both of them as net off. So this is how to treat incremental working capital. On the day of your exam, it is incremental working capital the examiner will give you. That's very common in ICAN exam. ICAN really give a one-off working capital because it's straightforward. All right. And this incremental working capital can come in different forms. All right. So when you see examples or likely exam questions, you will see what I'm talking about. Okay. So that is as per working capital. I said, let me repeat, under working capital, and I said when you are given a working capital in a question, it is relevant, you have to consider it. However, there are 2 different ways examiner can test you under working capital. You can be given a one-off working capital or you are given incremental working capital. If you are given a one-off working capital, you have to treat it as a cash outflow in the year before the year of occurrence. Then at the end of the useful life, you recover the entire working capital. So, and I also said, if you are given incremental working capital, the incremental working capital should be treated the same way as a one-off working capital, but only the increments should be considered. Okay, and I also demonstrated with examples how you can treat it. So this is how to treat incremental working capital, and this is how to treat relevant cash flow when you see them in the question. When you see any of these line items that I mentioned, these are the most common line item that you can be given in a question, and you must know how to treat each of them. You must know how to treat each of them. In summary, I said when you see variable cost in a question, you must consider it because they are relevant. When you see fixed cost in a question, ignore it. Fixed cost is not relevant except it is incremental in nature. All right. Then 3, if you are given depreciation, amortization, or provision, they are notional costs. They are not cash flow. Therefore, you must ignore depreciation. Also, if you are given interest in a question, whether it's in percentage or is in the absolute naira, you have to ignore interest because the cost of capital that you are going to use to discount the future cash flows already included interest. If you now include interest again in your calculation, that means you are treating interest twice. That's why you have to ignore interest. The next one is that if in a question you are given incremental fixed cost, direct fixed cost, specific fixed cost, attributable fixed cost, they are all relevant. You must consider it. The next one is working capital. And I said when you are given working capital in a question, you have to include it. You have to consider it because, and I said there are two different ways in which you can treat working capital depending on the nature of the cost. If you are given a one-off working capital, it should be treated as cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. But if you are given incremental working capital, you have to treat it the same way as a one-off working capital, but only the incremental cash flows should be considered. At times, examiner will not give you the working capital. You just be given state of information as per statement of financial position. You are going to be given balance sheet. All right. So from the balance sheet, you'll be able to see because we said that working capital is equal to current asset minus current liability. So you go to your balance sheet. What are the current assets given to you? What are the current liability given to you? Find the difference between the two. It will give you your working capital because it's not all the time that examiner will give you the cash flow. All right. It will be there in the question. Examiner will just tell you that this working capital will increase by 5%. So they will now give you information on the balance sheet. So you should be able to know what to do. Also, we talk about opportunity cost. We said opportunity cost is relevant because they are benefit forgone as a result of taking a particular course of action. So when you see opportunity cost in a question, you have to include it. And also, we talk about sunk cost. We said sunk costs are past costs. They are historical costs. They are costs that have already been incurred. So when you see sunk cost in a question, you have to ignore it. You have to ignore it because they are not relevant. Okay, so that is how that is what you need to know as far as relevant cash flow is concerned. So the next thing we want to discuss now is the impact of inflation in capital budgeting. How do you incorporate the effect of inflation into your cash flow when you want to determine financial viability of a project? Before we proceed, let me know if you have any question for me. If there's none, then we'll just go ahead straight. All right? Okay. Yes, Chinozo, talk to me. Chi,
Good
talk
evening.
to me.
Good evening, sir.
Good evening.
Okay, so my question is on opportunity cost. Opportunity
Okay.
cost. I think I want to understand it more. Or you said it's alternative or a benefit forgone.
Yes. Yeah.
So when you're explaining it, you make mention of having Uber, maybe the amount you're going to realize in using your Uber and maybe driving to the lecture hall. And the
Yeah.
second one, you mention of having a
Storage
storage
space. Yeah.
facility. Yes. So, but I want to understand how can we identify that okay, this thing is an opportunity forgotten? Maybe if you have that storage and you don't have anybody who is coming to ask you whether are you using it for your own storage or I want to rent this your storage if in case you don't want to use it. How do we identify the amount forgotten? And please, I want to also understand the difference between this opportunity cost and notional cost in this investment appraisal. Thank you.
The opportunity cost, like I said, is a benefit forgone. See, uh, it's what it is. Like I mentioned the other time that I'm a lecturer. For my lecturing activity, for my lecturing efforts, equity professional will pay me for my lecturing efforts. The equity professional will pay me my lecture fee. All right. Now, if I want to determine when I earn the income from equity professional, I need to determine what are the attributable costs, what are the costs I incur in earning the income from equity professional, right? For me to be able to do that, I'll begin to calculate it. Okay, maybe food and meals and entertainment, transportation, data. I begin to do all those expenses that I'm going to incur in carrying out my lecturing activity. All right. So at the end of the day, I'll be able to see, okay, maybe this is the net amount that I earn from my lecturing activity. Now, what I'm now saying is that as a lecturer, let's say, for example, I have my own, I have a car, and I can also use that car for Uber service, right? I can use that car for Uber service. So that means if I decide to use that car for Uber service, I will not be able to drive myself to the center to go and lecture. So that means I'm going to make two different revenues. I'm going to make two different revenue. One revenue from Uber service, then another revenue from my lecturing activity. But if I choose to drive myself to the center to go and lecture, that means the revenue that would have accrued to me through the Uber service, I'm going to forgo it. I will not be able to earn that revenue. Why is it that I was unable to earn the revenue? It's because of my lecturing activity. It's my lecturing activity that deny me that benefit. Therefore, if I want to determine the relevant cost, if I want to determine the relevant cost of my lecturing activity, I have to include that benefit that I've lost as a result of that. Okay, as part of my cost. That is opportunity cost. That is opportunity cost. So the second example I still mentioned that if you have a storage space, you can rent it out, but like you mentioned, Chino, so that what if there's no customer willing to rent the storage space? If there's if there's no market for the storage space, you cannot count it. You can only count it if there's market for it. Like I meant in my own example, you have that storage space, even though you are not using the storage, you are currently not using the storage space, but a customer has approached you that they want to rent the storage space. So because you want to use it for that project, you will not be able to rent it out again. So as a result, of course, that means you are going to lose the benefit that would have accrued to you from the customer. So you must include it as part of the cost of the project. All right. So that is what we mean by benefit forgone as a result of taking a course of action. The cost of action that I've taken is for me using the space for the project. The one that I've forgone, that I'm not going to use the space for, is the benefit that would have accrued to me through the customer. So you can only consider opportunity cost if there's a market for it. Like the one in the other example of my Uber. If I can't use the car for Uber, I cannot say that is opportunity. I've not lost anything. It is only when you lose that benefit that you can say, oh, okay, it's because of this that I lose that one. So that thing that you lost, because of this, you have to include it as part of your cost. I believe that is clear. Then you talk about notional cost. Notional costs are those costs that are not cash flow. It's something you are the one that made provision for. Like, for example, when you talk about amortization, they are not cash flow, they are not cash item. All right. So you cannot say they are not cash item. So because they are not cash item, they are just like, for example, somebody is owing you. You are just moping, you are not sure if the person will be able to pay the entire amount owing. Then you now say, okay, let me make provision that, okay, let me make a provision that's for bad debts. Say, okay, maybe 20% of the amount the person is owing you. So that is not a cash, you are just making a provision. All right. So those kind of costs like depreciation amortization or provision, they are notional cost. So because they are not cash flow, you cannot include them in your calculation. I believe that is clear, Chinozo.
Yes, sir. Thank you very much.
You're welcome. So let's go to inflation in capital budgeting. Let's talk about impact of inflation in capital budgeting. Of course, all of us, we know the meaning of inflation. We don't want to dwell so much on this. Of course, inflation is general increase in the prices of goods and services, leading to a fall in the value of money. As a result of inflation, the purchasing power of money will fall. The amount of goods and services that you can buy with money will reduce, will fall, or will decline as a result of inflation. The amount, let's say, for example, you have 100,000 naira. What you can buy with 100,000 naira in 2024 is not the same thing in 2025 because of impact of inflation. So as far as capital budgeting is concerned, there are two types of inflation. We have general inflation. We also have specific inflation. The general inflation is the increase in the average prices of goods and services as measured by in the economy, as measured by changes in consumer price index. That is general inflation. So general inflation will affect both the cash flow and the discount rate to be used to evaluate the project. I repeat, general inflation will affect both the cash flows and then the discount rate or cost of capital to be used to evaluate the project. So that is general inflation. For specific inflation is a kind of inflation that affects the elements that make up the project being evaluated. For example, when you want to evaluate a project, the project will have revenue, right? The project will have production costs like direct material costs, direct labor costs, direct expenses, variable overhead, variable production overhead. The project will have specific or attributable fixed costs. All these elements that make up the project, including the revenue, will have its own specific inflation. So there will be an inflation rate attached to revenue separate, inflation rates attached to direct material, inflation rates that will affect direct labor cost. So when you have that kind of inflation, then we said it's a specific inflation, all right? But again, let's go straight to what you need for the purpose of this class. Now, for the purpose of inflation, we have what is called money cash flow, and there is also real cash flow. Because in fact, this one is even is testable, is examinable. Examiner can ask you to explain money cash flow and real cash flow and how to treat them. All right. So what do you mean by money cash flow? Money cash flows are cash flows that include the possible effect of inflation. They are inflated cash flow. They are cash flow that has already been inflated. It's a cash flow that have been inflated. All right. So except examiner says otherwise, all the cash flow given to you in a question are supposed to be money cash flow. If examiner wants it to be real, you are going to see indication in the question to say this is a real cash flow. But except if your examiner says something else, you are going to assume that the cash flow given in the question are money cash flow. So I repeat, money cash flows are cash flow that include the impact of inflation. There is already the impact of inflation in money cash flow. Okay, then the second one is real cash flow. What do you mean by real cash flow? Real cash flows are cash flows that do not include the impact of inflation. They are cash flows that are stated in today's prices, year zero prices, first year prices, or current value terms. I repeat, real cash flows are cash flows that do not include the possible effect of inflation. They are cash flows that are stated in today's prices, year one prices, year zero prices, first year prices, or current value terms. So if, for example, in a question, you are told that selling price now is 2,000 naira, because examiner has mentioned now is the same thing as today. If in a question you are told now, immediately, okay, now or immediately, excuse me, let me write that. Okay, immediately or today, they mean the same thing. Examiner can call it now. If you say now, that means it is year zero. If you are told immediately, it is year zero. If you are told today, it is year zero. That's the way you are going to treat it. So if, for example, you are now told that variable cost in today's prices is 1,000 naira, that means it's a real cash flow. Or you are told that the selling price is currently 2,000 naira. Because the examiner has mentioned currently, it means there is a real cash flow. All right. So these are the way you are going to identify whether it's a money cash flow or real cash flow when you are given it in a question. All right. Again, just as you have cash flows, for the purpose of inflation, we also have cost of capital. All right. We also have cost of capital. All right. So basically, there are two types of discount rate or cost of capital. We have money cost of capital. We also have real cost of capital. Cost of capital, you can also call it discount rate, cost of capital, or rate of return. Examiner can, as far as inflation is concerned, if you are told rate of return, discount rate or cost of capital is the same thing. So for the purpose of inflation, we have money cost of capital and then real cost of capital. The money cost of capital is also known as nominal discount rates. Nominal discount rates is a cost of capital that include the possible effect of inflation. Money cost of capital is a cost of capital that includes the possible effect of inflation. Except examiner says something else, all right? Except examiner says otherwise, the cost of capital given to you in a question is assumed to be money cost of capital. Okay, so when you are given a cost of capital, say for example 10% in the question, an examiner did not say anything, you are not told whether it is money cost of capital or real cost of capital, you are just given a cost of capital of 10%, then you are going to assume it is money cost of capital. But if examiner wants you to do something, you may be told that a real cost of capital of 15% should be used. So once you are given a real cost of capital, then that means you need to convert it to money cost of capital if your cash flows are money cash flow. All right. So that is as per money cost of capital. Then we talk about real cost of capital. The real cost of capital is a discount rate that it's a discount rate that does not include the possible effect of inflation. It's a cost of capital that is stated in real terms. All right. It's a cost of capital that is stated in real terms. All right. So that's basically that. These are the things that you need as far as cash flow and cost of capital is concerned. That notwithstanding, you can just go through this to read more. You can go through this, and you don't need this one for anything because it is implied in the when you are doing your calculation, you are not going to make reference to this. All right. But again, it's good to know. You can just read it through. So read it through. All those ones are, let's go straight to what you need. Now, before we talk about general rules, it is possible in the question, if you are given real cash flow, and then you are now in a question, you are given real cash flow and then money cost of capital. You cannot use the two together. So you have to, it's either you convert that real cash flow to money cash flow before you can use the money cost of capital, or you will use the real cash flow as given to you, then you convert the money cost of capital to real cost of capital. Therefore, you must know how to estimate money cost of capital, real cost of capital, or even general inflation rates if you are given in a question. Because at times, examiner may give to you money cost of capital and then real cost of capital, but general inflation rate will not be given to you. At times, you may be given real cost of capital, general inflation rate, money cost of capital will not be given to you. Whatever the variable that you want to calculate that is not given to you, there is always a way out. Out of the three variables, out of money cost of capital, real cost of capital, and the general inflation rate, two of the three variables will surely be given to you, so that you are going to use the two variables to calculate to use the known variable to get the unknown variable. So that's what you need to do. Please, Nkechi, mute. Nkechi and OS Consulting, two of you mute. Your speaker is on. Okay, so how do you then calculate money cost of capital, real cost of capital, or general inflation rate? To do this, you are expected to use Ivy-Fisher effect formula. All right, Ivy-Fisher effect formula to get your money cost of capital, real cost of capital, and then general inflation rate. Professor Ivy-Fisher is the one that developed that developed this formula. All right. From the original equation, this is the original equation, all right, as stated by Fisher, right, as stated by Fisher. Now, when you want to, M is the money cost of capital, R is the real cost of capital, I is the general inflation rate. So from this original formula, if you want to calculate money cost of capital, you want to make M the subject of the formula. Of course, the original equation will still remain the same, except that the one that is standing behind M will go to the other side. So once this one moves to the next side, for the other side, it will become minus. And that's why whenever you want to calculate money cost of capital, this is the formula that you are going to use. You can just memorize it, okay? Whenever you want to calculate money cost of capital, of course, money cost of capital is calculated as 1 plus R multiplied by 1 plus general inflation rate, all minus 1. So that will give you money cost of capital. Again, from the original formula, if I want to calculate real cost of capital, that is, I want to make R the subject of the formula, because I can't just move 1 plus I away. So the best thing I need to do is to divide both sides by 1 plus I, because this 1 plus R and then 1 plus I, they are together. You can't just move one. Therefore, for me to get R, I need to divide both sides by 1 plus I. When you do that, then R will then be calculated as 1 plus M divided by 1 plus I, all minus 1. So this will give me the formula for calculating the real rate of return. Again, it is also possible in the question that you are given money cost of capital, you are also given real cost of capital, but the general inflation rate is not given to you. So to get the general inflation rate, the same way you calculate the real rate of return is the same way you are going to calculate the general inflation rate. So in this case, you want to make I the subject of the formula. To do that, you need to divide both sides by 1 plus R. So when you do it, the formula for calculating general inflation rate is 1 plus M divided by 1 plus R, all minus 1. So that is how to calculate discount rate as far as inflation in capital budgeting is concerned. So, but the most common one that you are going to likely need on the day of your exam is the money cost of capital or real cost of capital. So you can just ensure you memorize them because you don't know which one you are going to need. Okay, so that is as per that. Finally, as far as inflation is concerned, let's talk about general rules. Let's talk about general rules. I won't bother myself to be talking about all of them. Which one are relevant to you? The bottom line is that as far as general rules is concerned, you must use money cost of capital. Okay, you must use money cost of capital for money cash flow. That's rule number one. Rule number two, real cost of capital should be used for real cash flow. Rule number three, under no circumstance should you use real or money cost of capital. Okay, under no circumstance should you use money cost of capital for real cash flow or real cost of capital for money cash flow. It's not allowed. All right, that's a mismatch. When you do that, that's a mismatch. So the key thing is that whenever you want to incorporate the impact of inflation, you must ensure that you are using the right variables. So money cost of capital for money cash flow is what you should use. Okay? Real cost of capital for real cash flow. That's what you should use. Never should you use money cost of capital for real cash flow or real cost of capital for money cash flow. Okay? So that's not allowed. What do I mean by this? Okay, what do I mean by this? On the day of your exam, I've said it before. On the day of your exam, if in the question you are given money cash flow, all the cash flow given to you in the question are in money cash flow, but the discount rate given to you is a real discount rate or real cost of capital. You cannot use money cash flow for real cost of capital. So you need to convert either of the two. Is either you convert money cash flow to real cash flow before you can use the real cost of capital, or you leave the money cash flow as given to you, then you convert the real cost of capital to money cost of capital so that the two of them can match. All right. So that is what you need to do. That's the rule you must apply. Finally, under this is most important. Now, if in the question, the cash flow given to you are stated in first year prices, okay, if the cash flow given to you are stated in first year prices or year one prices, it means that you must start inflating the cash flow from year two. I repeat, if in a question, cash flow given to you are stated in year one prices or first year prices, inflation should start from year two. Now, the fact that I said inflation should start from year two does not mean that your n is equal to 2. Your n will still be 1. But the bottom line is that because you are given year one prices, this year one price is the base year price. So you don't inflate the base year price. So it is that base year you are going to use to get the subsequent years. That's why in this case, let's say, for example, the year one price given to you is 100 naira. And the useful life of this project is 3 years. Therefore, I would then say year one, year two, year three. Let's say this is selling price. I will then come here. I will say selling price. Selling price of, because it's in year one price. So for year one, in this case, I will just say 100 naira. I will not inflate the 100 naira because the 100 naira is a base year price. So I will then go to year two. This year two, if I like, I can do primary school method. I will just say 100 naira, 100 naira, then 100 naira. I will then come here, inflation rate. the one of year one, let's say, for example, inflation rate given to you is 5%. So you are given inflation rate of 5%. Therefore, for me to now inflate, I would then say 1 plus r raised to power n. In this case, this one will be 1 point, because inflation rate is 5%, 1.05 raised to power 0. You know, anything raised to power 0 is equal to 1. Therefore, this one will still remain 1 multiplied by 100. This will still remain as 100. So this is my inflated selling price. That's my inflated selling price. I will then go to year 2 and year 3. For year 2, it's still the same thing, the same rate, 1.05 raised to power 1. You know, I'm starting from raised to power 0, raised to power 1, then this one will be 1.05 raised to power 2. So what I'm trying to say in essence is that the fact that I said if you are given year 1 prices or first year prices, inflation should start from year 2. So the fact that I said inflation should start from year 2 does not mean that your N will be equal to 2. So that's the essence of all this analysis I'm trying to explain to you. So I believe that is noted. I'm coming for you, Ufoma. Hold on. Then the second one is that when cash flows are stated in today's prices, year 0 prices, or current value terms, inflation should start from year 1. If in the question there's indication to show that, okay, selling price or variable cost or fixed cost are given in today's price, year 0 prices or current value terms, it means that you should start inflating from year 1. So what will determine when you are going to inflate is either whether you are given, that is what will indicate or what will show you that you are supposed to inflate from year 1 or from year 2 will depend on the nature of the cash flow. So if the cash flow is stated in year 1 prices, today's prices, year 0 prices, or current value terms. So that is essence of this additional information I've shown you here. You must know when to inflate. All right. So I believe by the time you see our live questions, you will understand better. Yes, Ufoma, talk to me. You raise hand.
Sound like the features formula. You know, they gave us how to convert a cost of capital, real cost of capital to money cost of capital. What about in the case of cash flow? Can we still use that same formula, this same formula?
This is for cost of capital. You can't use it for cash flow. All right? It's specific for cost of capital, not cash flow.
So how can we convert money cash flow to real cash flow if it's...
You know, I mentioned it the other time, you don't need it. It's implied in the question. I just put this one here. This is it. If you want to convert cash flow, this is what you are supposed to use. But again, I've stopped talking about this, but most time when you are calculating, you don't even make reference to it because it is implied in the question. Now, if you want to convert money cash flow to real cash flow, let's say, for example, in a question, you are given money cash flow and you want to calculate real cash flow. So when you want to convert money cash flow to real cash flow, that means you are discounting because you have already said that money cash flow is a cash flow that includes the impact of inflation. Money cash flow has already been inflated. So if you want to convert it to real cash flow, that means you need to discount the money cash flow to real cash flow equivalent. So to do this, when you want to convert money cash flow to real cash flow, let me show you. You want to convert money cash flow to real cash flow. What are you supposed to do? Simple. You want to convert money cash flow to real. That means real cash flow is the subject of the formula. So real cash flow will then be the subject of the formula. In this case, I would then say money cash flow multiplied by 1 plus general inflation rate raised to power n. Okay, so raised to power minus n. So this will give you money, this will give you real cash flow. That means you are converting this money cash flow to real cash flow. When you do this, when you are converting money cash flow to real cash flow, that means you are discounting because the money cash flow is already increased with inflation. So if you want to deflate it, that means you are discounting it. That means you are calculating real cash flow. Again, if you want to convert real cash flow, if you want to convert real cash flow to money cash flow, that means you want to make money cash flow the subject of the formula. If you want to make money cash flow the subject of the formula, that means you need to increase the real cash flow. You need to inflate the real cash flow. When you inflate the real cash flow, that means you are compounding it. You are increasing the real cash flow to money cash flow equivalent. To do this, of course, you make money cash flow the subject of the formula. Then you convert this real cash flow to money cash flow by multiplying the real cash flow, multiply with 1 plus general inflation rate raised to power n. When you do this, that means you are compounding it. You are compounding the real cash flow. So this is how to convert money cash flow to real cash flow. This is how to convert money cash flow to real cash flow. So you saw that's what you have here. That's what you have here. Of course, in year zero, money cash flow and real cash flow will be equal to will be the same, because in year zero, n will be equal to 0. Anything raised to power 0 will be equal to 1. That means your real cash flow and money cash flow will be equal to, will be the same as far as year 0 is concerned. All right. So I hope you are clear now. Ufo? Okay. So that's that. Let's move on to taxation, impact of taxation. Yes. Let's spend additional few minutes to talk about impact of taxation in capital budgeting. How do you incorporate taxation in capital budgeting? Now, one thing you need to understand is that when a company incurs qualifying capital expenditure, the company is expected to claim capital allowance on the qualifying fixed asset or non-current asset. For example, if a company purchases non-current assets such as building, all right, furniture and fittings, equipment, plant and machinery, any qualifying capital expenditure, the company is expected to claim capital allowance on those assets. All right, because the primary purpose of capital allowance, okay, the primary purpose of capital allowance is to reduce taxable profits for the purpose of lowering your tax liability as a company. Because if you don't claim your capital allowance, your tax liability will increase. But once you incur qualifying capital expenditure, you are supposed to claim capital allowance in order to reduce your total tax liability. That's the primary purpose of incorporating of considering capital allowance in capital budgeting. So, as a company, of course, in practice and also in taxation as a subject, when you incur such an asset, in fact, the rule is that before you incur the cost, you must inform the Directorate of Inspectorate. There's a department within the ministry that that you're going to inform about the need, I mean, your intention to purchase that non-current so that they are aware. By the time you want to claim your capital allowance, you must show that certificate that, okay, before I bought these assets, this department or this ministry was aware. Any asset, I think that is about 500,000 naira. I've not checked the new acts, whether it has been revised now. So you must inform. If I'm digressing, that's purely taxation. But let's concentrate on what we are doing here. Now, Basically, the primary reason or the primary purpose of incorporating tax in capital budgeting are for three major reasons. One is to determine tax liability. When a project makes profits, when a project generates revenue or there's a profit arising from a project, the company is supposed to pay tax on the income arising from the project. Therefore, once you pay, you must determine the tax liability. And that's why when you want to determine financial viability of a project, you must include the impact of taxation. Two, you also consider taxation in capital budgeting for the purpose of tax savings on capital allowance, for the purpose of tax saved on capital allowance, okay? Like I mentioned the other time, the essence of capital allowance is to reduce tax liability. Then the third reason for incorporating tax in investment appraisal is for the timing of the cash flow. You want to know when are you supposed to pay your tax liability, or when are you supposed to claim your capital allowance? All right, when are you supposed to claim your capital allowance? That's the timing of the cash flow. Are you paying your tax liability in the current year that the profit is earned, or 1 year in arrears? All right. So these are the major three reasons for incorporating tax in capital investments. Then, what are the types of capital allowance? What are the types of capital allowance? For the purpose of finance, for the purpose of finance or in finance, there are four different types of capital allowance. We have initial allowance, annual allowance, balancing allowance, and then balancing charge. Okay, what do you mean by initial allowance? The initial allowance is an allowance claimable once in the lifetime of an asset. If you purchase an asset now and you claim your initial allowance, you cannot claim it again. It is only once in the lifetime of that asset. So that is initial allowance. For annual allowance, is an allowance claimable every year until the final disposal of the assets. Annual allowance is an allowance claimable every year until the final disposal of the assets. Once you dispose of the assets, that means there is nothing like annual allowance again. So everything will stop. All right. So that is annual allowance. So how do you determine your annual allowance? It's very simple. All you need to do is to multiply the annual allowance rates on the depending on whether it's on a reducing balance basis or on a straight line basis. Of course, I will show you later on as we proceed. Again, for the initial allowance too, just multiply the initial allowance rates on the cost of the asset. So that will give you the capital allowance for year one, for example. Now, in that year one, if in the question you are given initial allowance and then annual allowance rates, what that means is that you are going to multiply in that year one, you multiply initial allowance rates on the cost of the assets. Whatever you get, put it there. Then in that, multiply annual allowance rate on the cost of the assets. Whatever you have, put it there, you add the two together. So in year one, you are going to have double. Then subsequently, it will be annual allowance rates multiplied by the tax written down value. Okay, so that's that. If it is on reducing balance basis, okay? Then the third one is balancing allowance. The balancing allowance will arise when the tax written down value from the preceding year is higher than the sales proceed. I repeat, balancing allowance will arise when the tax written down value from the preceding year is greater or higher than the sales proceed. Now, this is what, let's say, for example, you have a tax written down value in 2024 to be 500 million. Then in 2025, this asset is now disposed of. It's now disposed of at 300 million. The asset that was in the books, in your book, the asset that was 500 million is now disposed of at 300 million. Therefore, the difference will represent balancing allowance. So once your tax written down value is higher than the sales proceed, it is called balancing allowance. So you now look for the difference. Like in this case now, the difference of 200 is what is called balancing allowance. Okay, so that is that. Then the next one, the last one is balancing charge. Balancing charge is just an opposite of balancing allowance. And balancing charge will occur when the tax written down value from the preceding year is less than the sales proceed. Okay, so when the tax written down value from the preceding year is less than the sales proceed, when the asset is disposed of, then we call it balancing charge. Balancing charge will always be in bracket. Say, for example, this asset is worth 500 million naira. In the books, this asset is worth 500 million naira. It's now disposed of at 600 million. Okay, the asset is now disposed of at 600 million. So that means the company has earned additional gain of 100 million from the disposal of the asset. So the difference of 100 million, this difference of 100 million will be taxed in the hand of the company, and that is what is called balancing charge. It's called balancing charge. Okay, so that is as per types of capital allowance. In most cases, you are not going to see annual allowance in the question. Annual allowance rates will not be given, sorry, initial allowance will not be given to you. Initial allowance rates will not be given to you. What you are going to have is annual allowance. So at the final disposal, every year you are going to be claiming the annual allowance until the final disposal. It is at that final that you are going to consider whether it is balancing allowance or balancing charge, whether it will be balancing allowance or balancing charge. It's at the final stage that you are going to do that. Once you dispose of the asset, then you need to consider the difference between the disposal value and the tax written down value will tell you whether it is balancing allowance or balancing charge. Yes, Charity, talk to me.
Sir, you said in a situation where you are not giving initial allowance, you have
Yeah.
to use only annual allowance. But then in this case, in tax, we do charge annual allowance. Then maybe on the last year of the asset, we will now minus one. Here, do we do that too?
Is it minus
In
1 or 10?
disposal of assets? 10,
You
yes,
don't
sir.
you don't do that here. This is finance. It's the way
Okay.
you treat it under taxation is different from the way you treat it in finance.
All right,
Right.
sir. Thank you.
Yeah. You're welcome. So that is as per types of capital allowance. What are the methods of calculating capital allowance? What are the methods of calculating capital allowance? Basically, there are two methods of calculating capital allowance. One is straight line depreciation method, then two, reducing balance method. When you talk about straight line depreciation method, what that means is that once you get the cost of the assets, you divide it by the number of years, by the useful life. So every year is the same amount, all right? It's the same amount you are going to consider. So for example, when you want to calculate annual allowance, for example, your capital allowance, like majorly is annual allowance. So, or let's say capital allowance, let me put it as capital allowance. So to get your capital allowance, okay, if it's going to be on a straight line basis, then it will be cost of the assets minus the scrap value minus the disposal value, divided by the useful life of the assets. All right, so that every year is the same amount you are going to be deducting from the tax rated down value. But if it's on a reducible balance basis, so what that means is that you are going to be multiplying the annual allowance rate on the tax rated down value. All right, you are going to be multiplying the annual allowance rates on the tax rated down value until the final disposal of the assets, when you are going to consider whether it is balancing allowance or balancing charge. Okay, so again, when you see live question, we will try the two. You will see the way we are going to treat it. All right, it's something very straightforward, not difficult. Done. Yes. What about the timing? I told you earlier today, some minutes ago, that the major purpose of incorporating tax in capital investments is, one, to determine the tax liability; two, to determine the tax saved on capital allowance; then three, the timing of the cash flow. That is, when are you supposed to pay your tax, or when are you supposed to claim your tax liability, sorry, to claim your capital allowance. Okay, so generally, tax can be paid or capital allowance claimed in the current year. So meaning that the year that the profit is earned is when you are going to pay the tax. For example, the profit that you earn in 2024 will be taxed in 2024. The profit of 2025 will be taxed in 2025. Profit of 2023, you pay tax liability on it in that 2023, or you claim your capital allowance in that same year. So that means it's in current year. But if it's in arrears, that means there's 1 year lag. The profit of 2023 will be taxed in 2024. The profit of 2024 will be taxed in 2025. Okay, so that is 1 year lag. It's the same thing with your capital allowance. Capital allowance, if your capital allowance is in arrears, that means the capital allowance you are supposed to claim in 2024 will be claimed in 2025, because there's 1 year lag. But the bottom line is that on the day of your exam, your capital allowance must follow the pattern of your tax liability. Okay, your capital allowance must follow the pattern of your tax liability. If your tax liability is in arrears, capital allowance must also be in arrears. If your tax liability is in the current year, capital allowance must also be in the current year. So you have to watch out for that. Now, I've already said it before, reasons for calculating capital allowance. The essence of capital allowance is to reduce tax liability. So you want to reduce your tax liability. That's why you are claiming your capital allowance. And you must claim the capital allowance before you calculate your tax liability. Okay, so finally, under this, how do you calculate tax saved on capital allowance? How do you calculate tax saved on capital allowance? So anytime you want to appraise a project, an examiner has given you tax depreciation or tax allowable depreciation. So in that case, you have to calculate, you can either use capital allowance to reduce your tax liability, or you use tax saved on capital allowance to reduce your tax liability. Whichever of the two, you get the same answer, even though different ways you are going to calculate it. However, if you want to use tax saved on capital allowance to reduce your tax liability, first thing first, there are two stages. You need to first of all calculate your capital allowance. After that, then you now calculate tax saved on the capital allowance. How do you do this? Using this format, okay? In year 0, you have the cost of the assets, so much. Then in year 1, you want to claim your capital allowance. To do this, you go to the question, are you given initial allowance rates? Are you given annual allowance rates? If you are given initial allowance rates, then you are going to multiply the initial allowance rate on the cost of the assets, whatever you have. you post, you write it down somewhere. You also multiply the annual allowance rate on the cost of the assets. Okay? You then add the two of them together. Whatever you have, you come and less from the cost of the assets. So that means in year one, you have double allowance to claim. You are claiming initial allowance, you're also claiming annual allowance. Then you find the difference between capital allowance in year one and then the cost of the asset. So the difference will give you the written down value, tax written down value at the end of year one. You then move to the following year, the next year, which is year two. So when you get to year two, this will depend on whether the capital allowance you are going to claim will depend on whether you are using straight line depreciation method or you are using reducing balance method. So whichever method you are going to use, it will be very clear. It will be there in the question. You'll be able to see it. Which method are you supposed to use? All right. So in this format, we are assuming is on reducing balance basis. Therefore, you then multiply the annual allowance rates on the tax written down value. Let's say annual allowance rate is 10%. I will say 10% of whatever you have as your written down value. So you less. You move to the next one. Okay? So that will give you the written down value for the third year. That will give you the written down value for the third year. In this table, my assumption is that the useful life of this asset is 3 years. Therefore, at the 3 years is the final year. So at this final year, I'm not going to calculate annual allowance. Rather, I will check whether it will be balancing allowance or balancing charge. How am I going to do that? First thing first, since I have written down value already, so all I need to do is to less the scrap value or sales proceed at that final disposal, at that final year. I will less the sales proceed from this. Whatever balance I have can either be balancing allowance or balancing charge. So if the tax written down value, if this tax written down value is higher than the sales proceed, it is called balancing allowance. But if tax written down value is less than the sales proceed, it is called balancing charge. All right? It is called balancing charge. Okay. So that is as per that. Now, if I want to use capital allowance to reduce my tax liability, so I will just pick all the capital allowance that I've computed, okay? All these capital allowance that I've computed is what I'm going to select. What are the capital allowance? The first year, this is the first year capital allowance. This is the second year capital allowance. And then this is the third year capital allowance that I will use to reduce my tax liability. I will go and calculate my tax liability separate. I will bring out the profits. From the profits, I will less capital allowance. Then I will have taxable profit. On that taxable profit, I will apply the tax liability, the company tax rates. So that will give me the tax liability that I'm going to pay. Okay, but if I want to use tax saved on capital allowance to reduce my tax liability, in this case, after I've calculated the capital allowance, okay, after I've calculated the capital allowance, I need to multiply the company tax rates. CTR is company tax rates. I need to multiply company tax rates on capital allowance. All the capital allowance I've calculated here. For example, this is the first year capital allowance. I would then say, let's say 30% is the company tax rate. I will say 30% of whatever figure that I have here, then I will put it here. I will go to year two. 30% of the capital allowance in year two, I will put it there. I will go to year three, which is the final year in this case. Then, of course, in that final year, the tax saved can either be if it is balancing allowance, okay? If it is balancing allowance, I will say 30% on the balancing allowance. I put it there. If it is balancing charge, 30% on the balancing charge. I put it there as a negative. All right. If I like, I can add up. I can add up all the tax saved together. I will add up all the tax saved because the essence of this is to confirm that what you have not claimed beyond or above what you are supposed to claim, all right? Because you are not expected to claim beyond what you are supposed or above what you are supposed to claim. So in this case, I will add up all the tax saved on the capital allowance to get this will give me the total tax saved. This is total tax saved. Add everything together. So if I want to confirm if what I've calculated is the same, or if what I've calculated or I've claimed as a capital allowance is what it is, then I will just use formula to get it. I can use formula. I will say total tax saved. Total tax saved is equal to the cost of the assets minus the scrap value or multiply by company tax rate. So whatever you have here and what you have here, they must be the same. The two of them must be equal. Okay? The two of them must be equal. So that is how to calculate tax saved on capital allowance. That's how to calculate tax saved on capital allowance. Finally, we're almost done. So let me show you the formats that you are supposed to use whenever you want to calculate NPV or even internal rate of return. Let me see if I can get a space, an empty space in this material. If not, I will switch to the working notes. Okay, let me use it. Excuse me. Let me use it. Okay. Yes, format for calculating MPV, for example. All right. Should I use this one or go to, okay, let me just use the format for calculating MPV. So I would then say calculating net present value, for example. Let's say our figures are in million naira. So let's say the useful life of this project is 3 years. So I have year 0, year 1, year 2, year 3, then we create a column for workings. Okay. So because I don't know the extent of my table, I cannot rule the column. So I will leave it as it is for now. All right. So the first item in this format will be the sales value. How do you determine your sales value? You go to the question, all right? You go to the question, are you given selling price? If you are given selling price, you also need to deep down, you need to deep down further to check if you are given inflation rate. If you have inflation rate, so you inflate the selling price. After inflating the selling price, you then multiply with number of units sold. Whatever you have, then you come and post. This will give you working number 1. Then you go to working number 2. You check from the question if you are given variable cost. Okay? So you go back to the question. How much is the variable cost? Is there any inflation rates given to variable cost? If any, then you discount it. I mean, you inflate it. After inflating it, then you multiply with number of units produced. Whatever you have, again, come and post. It's a cash outflow. Working number 2. All those things I was explaining earlier in relation to relevant cash flow. This is where you are going to be applying it. This is where you are going to apply a variable cost, incremental, attributable, specific fixed cost, depreciation, working capital. This is on this format is where you are going to be applying all of them. Okay? Then you also go back to the question, if you are given any direct or specific fixed cost, if you have any specific fixed cost or attributable fixed cost, then you must consider it. Okay, any relevant cash flow, this is the table you are going to indicate it. So because it's a fixed cost, it has nothing to do with activity level. You don't need it with number of units. Therefore, you may not, there's no need for you to be doing working for your attributable fixed cost. All you need to do is to check if there's any inflation. If there's inflation, then you inflate. You can inflate using your calculator. But if you want to do working for it, go and do it. No worries. Okay, so after that, you come and post. If you have done working for it, then this will be working number 3. Then after this, you need to add up everything together. If there is any other relevant cash flow that you are given in the question, you have to include it. But in this example, in this format, we're assuming that we have variable cost and then specific fixed cost. So you add up. By the time you minus the cash outflow from the cash inflow, you are going to have profits. So, when the company earn profit, you are supposed to pay tax on that profit. Therefore, you must, immediately after your profits, you have to consider tax liability. Now, in this tax liability, you want to know, do you want to use capital allowance to reduce your tax liability, or you want to use tax saved on capital allowance to reduce your tax liability? Examiner will not tell you to use capital allowance or use tax saved. Whatever that is more convenient for you is what you should use. But at all time, I will suggest that you always use tax saved on capital allowance to reduce your tax liability. Therefore, immediately after profits, I will calculate tax liability at company tax rates. So I need to ask, what is the timing of this tax liability? Am I paying my tax liability in the current year or in arrears? So it will be there, the information will be there in the question. But in our example, we are assuming that tax is paid in the year the profit is earned. Therefore, I will multiply company tax rate, let's say 30%, on the profit of the first year. I will deduct. Profit of the second year, I deduct. Profit of the third year, I will deduct. All right. Then immediately after this, I need to consider tax saved. Tax saved on capital allowance. Like I said, the capital allowance must follow the pattern of tax liability. All right. So I will go and calculate my tax saved on capital allowance using this format. The format I showed you the other time. Oh, I've even gone so far. Look at, never knew I was looking for space. So this format that you have here for calculating capital allowance, all these formats, so you go and calculate your tax save here. Whatever the numbers that you have there is what you are going to put in your calculation if you are using tax saved on capital allowance to reduce your tax liability. So in this case, I will then come here after I've done my calculation. I'll put it down. So this will reduce, by the time you minus the tax liability and the tax saved, you see the net amount. Okay, so let's say this is working number 4. Then after tax saved on capital allowance, you also need to consider sales proceed or scrap value. In case there's a disposal of an asset. All right, so this will usually occur at the final year. It's a positive, it's a cash inflow. Then after the scrap value, you consider the initial outlay, the initial cost of the project. It's usually at the beginning, year 0. So it's a cash outflow. Then after this, you also consider from the question in case you are given working capital. Working capital. So you then go back to the question, what kind of working capital? Is it a one-off working capital or incremental working capital? Whatever the case may be, you should know what to do. But based on our format, we're assuming that it's a one-off working capital and this working capital will occur in year one. So if the working capital will occur in year one, year before year one is year zero. So we are going to treat it as cash outflow in year zero. Then at the end of the useful life, which is year three, we recover the working capital. So at this stage, you need to find the net cash flow. So you add up everything, add it up, add up, add up. This will give us net cash flow. So after the net cash flow, at this point, you can use any technique. You can use any technique to appraise, to evaluate the project. You can use NPV, you can use internal rate of return, you can use even payback period, because this is cash flow. You can use payback period, but the only technique that you cannot use is accounting rate of return, because accounting rate of return makes use of accounting profits. All right, makes use of accounting profit. You don't use cash flow. All right, so that is that. Then after the net cash flow, we are calculating for NPV. So you need to discount this. So you then say discount factor. Discount factor at the discount rate. So if you have inflated your cash flows, the discount factor that is given in the question, you have to be careful. What kind of discount factor? Is it money cost of capital or real cost of capital? Whatever the case may be, just go and calculate your, if it is money cost of capital and you have calculated money cash flow, then that means the cost of capital is suitable. But if it is real cost of capital you are given, you must convert it to money cost of capital using Fisher effect formula. So whatever the case may be, just put your discount factor here. All right, put your discount factor there. So you multiply to get the present value. You multiply to get the present value. So this is present value. And we said that NPV is the difference between the present value of cash inflow and present value of cash outflow in capital investment. Therefore, I will add up first. I will add up the positive present value, 1, 2, 3. I will add the three of them together, then I will less the cash outflow. So you can either have positive NPV or negative NPV. So that is how to calculate net present value using columnar format. So this format is mostly suitable when you have multiple variables. I repeat, this format is suitable for calculating NPV when you have this columnar format is suitable when you have multiple variables. In the question, you have sales value, you have variable cost, you have attributable specific incremental or direct fixed cost. All right, you have scrap value, you have working capital, you have inflation, you have taxation. This is the most suitable format that you can use that will help so that you don't make mistake. You can't use this normal small table that we use under cost of capital for calculating NPV when you have those multiple variables. All right, so I repeat, whenever you have multiple variables, this is the format you are expected to use to calculate your net present value. Okay, so that is all about the explanation underlying the capital budgeting decision. We are done with explanation of capital budgeting decision. So subsequently, especially in our next class, what we are going to be doing are purely calculations. So we have 2 more periods to complete this topic. So between now and our next class, what we are going to be doing are just calculations. So I need you to go back, okay? Go back to your notes from day one, since last week when we started this topic. Go and revise all our discussions so that subsequently when we start calculations, so you are not going to draw us back. You already understand all those concepts. That notwithstanding, you can always ask questions if there's anything that is not clear to you. But I need you to go ahead and then and go and read the concept that we have discussed so far. So that is from me to you. Let me know if you have any question for me before we close the class for today. Yep. Any
Hello, sir.
question? Yes, who is speaking?
It's me, Foma.
Okay, talk to me.
Yeah. If you are using this, if we are not using a tax save method, if after
Yep.
the profits, we deduct capital allowance before we do the tax.
Yes. So, like I said, in the format, for example, let me go back to the table where I gave it the format for NPV calculation. Now, in this format, right, this place where you have your tax liability. So, if you are using capital allowance to reduce your tax liability, the way you calculate it in this format is not the way you are going to do it if you want to use capital allowance to reduce tax liability. So, first thing first, you are going to bring out the profit that you have here. This profit that you have here, this same profit, you bring it out. So you come and put it, if you want to, you are going to calculate your tax liability separate. You say tax liabilities. Okay. So let's say you have 3 years as it is. So you do for year 1, year 2, then year 3. You then go to your calculation. The profit that you have here, this same profit that you have here, you bring it out. So you then put the profit here, whatever it is that you have there as profits. The next thing you are going to do is to deduct capital allowance. Capital allowance. Which of the capital allowance? The capital allowance you have calculated before. You know, when I was giving you the notes, the format for capital allowance, that table, let me quickly show you. So all these capital allowance you are calculated for each year. Let me, what's wrong with you? That. Okay, so all this cap I'm trying to erase it is writing again instead of cleaning it. Don't mind me. So all this capital allowance, the one you calculated in year 1, capital allowance of year 2, then capital allowance of year 3. So all those figures, then you come and post it there, you come and deduct it from the profits, right? You come and deduct it from the profits. So you come here, you deduct the capital allowance, okay? So the difference will give you taxable profits. This will be taxable profits. After the taxable profits, now that you have taxable profits, then you need to slam the company tax rates. You calculate, you slam company tax rates on the taxable profits. So I would then say tax at company tax rates. So on each year, depending on whether tax is paid in the current year or 1 year in arrears. So I will then multiply company tax rate on the taxable profit. Whatever I have, I put it here, put it here, put it here. So it is this one I will now take to my NPV calculation. Whatever I have here, all these figures, I'll bring it under my tax liability, under this area. So I will now list. So if I'm using tax saved, if I'm using capital allowance to reduce my tax liability, tax saved will not be there. I will not include this tax saved line will not be there at all because I'm using capital allowance to reduce my tax liability. So that's different between the two. Whichever of the two you do, you are going to arrive at the same answer. But tax saved on capital allowance is faster. So instead of me to go and be drawing another table to calculate tax liability, why don't I just use the tax saved to reduce my tax liability? That's why I love to use tax saved instead of using capital allowance. All right. So, but again, you have to master the two because at times in a question, it may be difficult. You may not be able to it may not be too clear for you to use task saved at times to calculate it. So that's why it's better for you to master the two. But in most cases, it will be task saved. Just move on and you are good to go. Okay? Yes, Ufoma, are you fine?
Yes, sir. Thank you.
You are welcome. So, any other questions so that we can close the class? Our time is up. Any other question? Okay.
I
So,
want to ask a question, but it's relating to
who's
the class
speaking?
before. Um,
Hello? Who's
hello,
speaking?
sir. Minister of Finance.
Oh, okay. Minister MOF. You see, you are not doing well, because we can't have you and we are and we are lacking. And you have not brought your contracts. And time time is going. Is it when we finish the diet you are going to bring your contracts?
No, no, no,
Talk,
sir. Don't worry, sir. We got your back.
talk to me.
Yes, my question is relating to the practice question in cost of capital. I'm sorry, I'm
Yes.
taking it back, but I need to
Mm-hmm.
ask this. Like the
Right.
way ICAN solve their own, I discovered the question is ICAN adapted. So I don't know if you could share us some light after you've gone, maybe after you've looked at it. This JP Gene that DPLC. So I'm having issue with how they computed their convertible security.
It's very
So,
straightforward now. Okay, you don't have access to Golden Book.
no,
My
sir.
SFM Golden. Oh, okay.
I'm planning to do that by this month end, by God's grace.
Uh,
I need that material too because
okay. Let me show you. Let me stop sharing this, and it's well simplified in the Golden Book. Sorry guys. Let me know if you can see my screen.
confirm, sir.
Oh, okay. Cost of capital. What did I save the name with self? Jan Dollar. I think so. Let me Control F.
Very
Control F.
likely we that are not in Lagos, sir. So is it the soft copy we have access to, or there will be a web bill for us? Because me, I'm in Jos.
We will send goods to almost on a regular basis. Send goods to books to Jos.
Wow.
Yeah.
Okay.
Jan Dollar. I think Jan Dollar. Let me see if I bring it out. Uh, yeah. Don't waste my time. Okay. Yes. This is the question you are talking about, right?
That's correct. Yes, sir.
So say you have issue in identifying how they calculate the
Cost of debt and convertible security.
yes, now. Okay. Let me just show you. Now, the KD, according to the question, the the convertible security, the convertible bond, 7% convertible bond is 160 million. So you want to know how we arrive at that figure, right? Okay. So to do this, of course, I explained to you that you are supposed to, when you are calculating cost of convertible securities, the higher of the redemption value and the conversion value should be considered, isn't it? So first thing you need to do is to go and do your working on the conversion value. So when are you supposed to exercise, when is the investor supposed to exercise his or her rights of conversion? So you go and calculate your conversion value. So if we go to, for example, I have working about 5 years, that's how I calculated. So look at it here. In this working about 5, so the bonds will be converted to ordinary share in 5 years' time. That's when the right will be exercised. And the share price is expected to increase by 4% because according to the question, examiner told you that the share price will grow by 4% per annum. So in this case, you must first of all grow the share price before you calculate the conversion value. So if that is the case, the current share price is 5 naira. How do you get the current share price? So of course, this is the share price there. The share price, you are in the question, you are given total market value of 1 billion naira. The number of shares is 200 million naira. So to get the share price, is one total market value divided by number of shares. That's what gives us this 5 naira. So you are now told that this in the next 5 years, so this five naira share price will grow by 4%. Is it 4%? Yes, will grow by 4%. So to calculate that the growth, so of course, A will represent the cash flow. The cash flow in this case is 5 naira. G is the growth rate of 4%. N is 5 years. So when you put it in that formula, the share price in 5 years' time will then be equal to 5 multiplied, because we are using this formula, multiplied by 1.04 raised to power 5, and we got 6 naira 8 kobo. So to now get the conversion value, you need to multiply this share price in the next 5 years. You multiply this 6 naira 8 kobo with the number of shares you want to convert to. Because according to the question, you are told that the debenture can be converted to ordinary to netting shares, can be converted to netting shares. So you multiply netting shares with the market price in the next 5 years. So that's what gave us this 116 naira. So it is this 116 naira you are going to compare with the redemption value. So conversion value is 116 naira. If you want to redeem the bond in the next 5 years, it will be at par. At par means at 100 naira per unit. So since conversion value is greater than the redemption value, that's why we are converting it. So when you go back to the calculation that I did here, you see that you are seeing 116 naira here. Is it clear now, Minister of Finance?
Yes, sir. Is that good to it? Is that good to it that I messed it up? I didn't
No,
understand this.
it's okay. So that's what you need to do.
Thank you
All
very
right.
much.
So somebody is sending a message. Aisha, how can I get the golden book? Also anywhere you have, provided it's not in the notes inside not like in notes anything anywhere from North Central, southeast, southwest is Abuja. So it's because they want send it to northeast, northwest, like Kaduna, like Borno, all those areas is very difficult. You have to go very far. The motor park in Lagos is far. That's why we don't like sending to those areas, except if you have somebody that is coming from Lagos to your place. So you can ask the person to pick it up. But any other place, oh, Aisha, you're in Kaduna, you're on your own. No. Except if so, for
Now you said
example,
from Jos to go to Kaduna.
just is straightforward. You can always get just around there, so that's not a problem. So except that if you're staying for then you can get the ebook. You can get the ebook. So if you are just send me the WhatsApp chat, then I will tell you how you are going to get your copy, whether hard book, or whether the printed copy or the ebook. So whichever one that you want, you can always get it. Yep. Okay, then. So that will be that for today. We are going to meet next time by the grace of God when we shall be starting calculation. So I want to say thank you to every one of you for waiting behind and participating in the class. I will see you next time by the grace of God. Good night, everyone.